Promoters often focus on how much they earn, but how you take out the income from the company may change your tax outcome completely. When promoters or shareholders wanted to repatriate income from the Indian company, there are multiple modes of repatriation available, and each mode is very different. Let me talk about four most common repatriation modes. Number one, dividend, which is the simple and straightforward mode. For the resident individual shareholder, dividend is taxed at the income tax slab rates, with the surcharge capping to 15%, resulting in the effective tax rate of 35.88% in the highest tax bracket. However, for the non-resident shareholders, dividend is taxed at the tax treaty rates, which typically ranges between 10 to 15% depending upon the country in which you are a resident. However, such dividend will still be taxable in the country in which you are a resident as per the local income tax rates. This is the very simple and most commonly used mode. Number two is the buyback of shares. While from an income tax perspective, buyback is taxed akin to dividend. However, from a corporate law perspective, buyback of shares by a company in the financial year is limited up to 25% of paid up capital and free reserves. Interestingly, buyback of shares can be used to restructure or increase the promoter holding into the company. Number three is the capital reduction. From an income tax perspective, capital reduction is taxed akin to dividend as per the availability of accumulated profits into the company. However, from a corporate law perspective, capital reduction requires the NCLT approval. While it is a capital repayment, but the income tax treatment is often similar to dividend. Number four is the capital redemption or restructuring your holdings via preference shares. This is where the structuring becomes important. In a growing company, the promoters may often restructure their holdings via subscribing to preference shares, whereby the terms of preference shares can be set in such a way that upon achieving milestones, such preference shares can be redeemed at a premium. From a corporate law perspective, the redemption of preference shares at a premium is subject to availability of free reserves into the company. However, interestingly, from an income tax perspective, capital redemption is taxed as a capital gain, and long-term capital gain, if any arising, is taxable at 12.5% plus applicable surcharge and cess. This is where the capital redemption is very different and may change your income tax outcome completely as compared to dividend. To conclude, when you talk about repatriation of income and modes of repatriation of income, there is no single best mode. The repatriation mode will completely depend upon your residency, your long-term objective, and the company's growth profile. If you are planning to repatriate income from the company or evaluating to restructure your holdings, choosing the best mode of repatriation upfront may completely change your income tax outlook. Follow me for more updates on tax, regulatory, and transaction structuring inputs. Thank you.